Hello, this is Mike Swanson. I run the website wallstreetwindow.com, and the odds are you're watching this video because you got an email from me telling you that it's up as being on my free email list. Now, if you're not on that list, click the link associated with this video and subscribe, and that way you'll get my morning email updates. And if you're just randomly watching this on YouTube, click the YouTube subscribe button with the video, and then click that bell. That way YouTube will notify you as soon as the next video is up instantly. Because there's a lot of interesting things happening in the markets, and I have to comment on them today because we saw the NASDAQ get smashed for a 2% decline. The Dow fell over 100 points, the S&P 500 over 20. And there are some worries out there about a bigger market decline. However, I don't think we're going to see one, not now. Typically, the stock market does well at this point going into the end of the year. Next week, we're going to have a Federal Reserve meeting, which is going to bring some interest into gold and silver, but that's next week. But it's really the bigger picture of the market that I'm not so concerned about. Yes, I know stocks are extremely overvalued. We're seeing a bit of weakness in technology stocks, which is likely to continue. We can talk about all kinds of problems in the economy, mass unemployment, but we have a Federal Reserve that not only has interest rates at zero, but pledged unlimited quantitative easing if necessary back in March. They're likely to make some dovish statements next week. What would concern me, though, about the stock market is if it reached an extreme overbought condition in which it just went shoop like that over 3 or 4 weeks. That would set it up for a likely 10% or greater correction. We saw that, in fact, happen in September. Let me show you some of the charts I'm looking at. In September, the S&P 500 got extremely overbought. It went up just about over 70% from the March low without any meaningful decline. You don't see it on this chart, but RSI hit an extreme. The price rate of change, which I'll show you in a few moments, hit an extreme. Extreme overbought readings lead to corrections, consolidations, even in bull markets. That's what happened. The stock market fell roughly 10%. It did that in 2018. It fell 20%. In 2017, there was a flash crash, an extreme overbought Dow condition. In February, the market went up almost every day in January. Flash crash happened. We don't have such an extreme level now. If we see one at some point going forward, and it could easily happen, then I would be very worried about some sort of correction. But we don't have that. Instead, we have a market situation that's a little bit different, which I'll show you in a few moments. But first, today's action shows one thing that is happening that I do think is going to continue. While the S&P 500 fell roughly 0.79%, the NASDAQ 100 fell 2.26%. Well, the NASDAQ 100 is sort of lagging the market now, lagging the S&P 500. It led up into Labor Day, but now is lagging because what we're seeing is a money rotation going into sectors that had been lagging the market up until October, November, and money is now flowing back into them. Things such as airlines, things such as casinos, so-called consumer companies, bricks and mortar companies that were the biggest victims of the shutdowns and the pandemic. Now traders are thinking about the future where these companies can come back fully online with probably 6 months from now. People aren't waiting to shift their money into that event. They're doing it now. And I think that process is going to continue because big cap tech stocks are extremely overvalued and money is shifting into bargains. Now, the sad story is this is not going to happen. There's lots of companies going bankrupt. You drive down the road, you can see them. But the stocks in the stock market are typically the biggest companies in the country. Many of them are able to weather the storm. They raised many dollars in March and April in the bond market, and they're waiting to sit and come back fully online and actually taking more market share away from people that are unfortunately going to fall from the wayside. It's not something I like, but it's something that's happening, and that's what I'm here to tell you about, what is happening with the markets and likely to continue to keep on top of the trends. And one of those trends is big cap tech stocks have been trading weak really since Labor Day. For example, let's look at Amazon. Amazon is obviously one of the biggest beneficiaries this year of what is happening in the economy, and the stock went up to show us that. That plot on the bottom of the chart is, oops, I got a mistake. That should be AMZN. This plot at the bottom is the AMZN divided by S&P 500 ratio. It's a relative strength ratio of comparing the performance of Amazon in this case to the S&P 500. When it goes up, it means Amazon is outperforming the stock market. That ratio peaked in July, and now the S&P 500 is outperforming this Amazon. While the S&P 500 just made a new high on the open today, Amazon is trading on a low from the open this December, is actually lower than it was at the start of October, and remains lower than the peak of Labor Day. This is also the case with many other tech stocks. Facebook, for example, also lagging the S&P 500. Money is rotating out of those winners, searching for what are, in some cases, truly are bargains. And even if they aren't, companies that are expected to come alive, see earnings increases, revenue increases next year, in which they very substantially suffered this year. And one exchange traded fund, which also is representing this, is the Russell 2000. The Russell 2000 does not have the Facebooks, does not have the Amazons, does not have the Googles in it, or Netflixes. It's the 2,000 smallest stocks in terms of capitalization in the U.S. stock market. And it now is outperforming the S&P 500, and this is likely to simply continue at least into the end of the year, I think, into the summer of next year at the minimum. So that's what I'm focusing on with some of my money. Smaller cap stocks that I think are in position to outperform in sectors that had been lagging that are now coming alive. One such sector I'll mention is energy stocks. Energy stocks perked up this week and actually were up today when the rest of the market declined. I actually did a post on my website, sent out an email alert on Tuesday about several energy stocks that I actually have bought and I think will do much better than the big cap tech stocks over the next 6 months. To name just one, Exxon, and Exxon is paying a dividend around 8%. Now, let's step back for a second and talk about the big picture and why I don't think we're on the verge of a giant decline in the stock market, even if the tech stocks trade a little bit weaker. I think we're entering a new phase in the market in which volatility is only starting to slowly go down. We saw extreme volatility this year. In fact, I would say that's the defining characteristic of this year. Again, this is a chart of the S&P 500 going back 20 years. Now, that indicator ROC stands for rate of change over 90 days. That's how I've got it measured. And we saw the biggest decline and then surge in this indicator in the history of the S&P 500 in a compressed amount of time this year, because the stock market The S&P fell over 30% and then went up 70% on that low. A historic expansion of market volatility. That caused the 200-day Bollinger Bands to expand. Those are the two enveloping bands surrounding the S&P 500. The Bollinger Band width indicator is on the bottom of this chart. Historically, it trades below 20. It's currently trading above 41. I think what we're going to see next year is, and it's going to be a slow process, is that Bollinger Band width indicator to return to the mean of 20. That rate of change indicator, as you see, I've circled, has also historically traded between 20 and -10 in a typical year. I think we're going to return into that range, actually touch the zero level at some point next year. But this is a process that's going to take months, and it will ultimately set the stage for what will become either a major top of the market or for a more larger decline than the type of decline some people are scared of now, but it's just not in the cards right now. It will take a shrinkage of volatility. That's a long drawn out process, and that can lead to a gain, not a decline, but it needs that to happen first. So that means don't be overly worried about the market. I don't think it's time to try to short the stock market. It may be time to rotate out of what were previous big winners, the Amazons, the Facebooks, the Netflix, the Googles, and so forth, and go into more value plays. Look for some stocks that have in sectors that are much bullish, a different type of configuration. I talk about them all the time: the gold, the mining stocks, commodities, and now oil is coming alive, or energy stocks at least is coming alive. So we're in an interesting time in the markets. And another reason I think it's going to take a long time for this process of shrinking volatility to play out is the VIX. The VIX is the volatility index. I probably should do an entire video dedicated to it, but it measures the premium that traders are paying in the options market for volatility. It tends to shoot up when there's pure panic in the market, which is what we saw this March. The VIX went up above 80. It happens because people are in and some people are willing to pay any price to buy puts when that happens, and they drive the volatility up. Well, past spikes, as you can see, over 35 leads to bottoms in the market. We got over 45 in 2018, over 45 in 2015, 2011. There was a flash crash. 2008, of course, it spiked up over 80. So we had a mega spike this March. What's important, though, is that levels of complacency are at least below 15, and you get even below 10. Well, we're still above 22, and it's going to take months and months and months to get to the below 15, at least into the spring. So we got a lot of time for the volatility to shrink, not just in terms of the Bollinger Bands and true price, but in terms of sentiment when it comes to indicators such as the VIX. So the backdrop, I would say, of the market that despite the drop of the NASDAQ today, and the Dow, and the S&P, and some worries, despite the reality of the horrible economic situation that still continues, the true backdrop, the true environment that we're in when it comes to the U.S. stock market, I would say, is no different today than what you saw begin, let's say, after the day after the election. The November environment and the December environment are likely to continue over the next 3 to 6 months, at the very least. So expect what you've been seeing to continue. Expect continue lagging behavior in QQQ and tech stocks, outperformance in Russell 2000 and special sectors, and some beaten down things that lagged for a very long time, now on the position to come alive, such as energy. So that's my kind of overall view of what's going on in light of today's decline, and why that decline does not worry me. So all that said, if this is the first time you've seen me on YouTube, click the subscribe button on the YouTube video and click that bell and get the next video when it's online.